Greetings. Sorry, we're a few minutes late. We had some technical difficulties that we worked through, but I think we are in good shape now. Tyler, how you doing today, man? Oh, you're muted.
The technical difficulties continues. I'm doing great, man. Great start to the year. Excited for our ongoing conversations that'll be happening once a month. It's gonna be a good time, man. Lot happening, a lot of news. So,
oh yeah, a lot going on. Been some pretty spicy takes, some really good takes, I think, that we're going to talk about. Of course, with whether you should be doing open market buybacks, burns, the announcement from Helium, and our main takeaways there. I'm also, by the way, very excited to be doing these monthly because I know we did one towards the end of last year, and it was a really great discussion, man. And I think, well, for one, I need to create a new intro video for the show. That's different from my live stream, so I'll work on that as well before the next episode. But man, there's always a lot to talk about, and I think especially right now as we come into the new year, I think it's gonna be a really great discussion. So super excited to be doing this, man.
Yeah, man, I'm also equally excited, and you and I have a lot of great off-camera conversations about kind of our takes, our outlook, things that we're looking at, and so, you know, as they say, build in public. Now we're chatting in public, which is awesome.
Indeed, yeah, we do have a lot of conversations that I think could bring value, and I think it's just great right now. Like just in the last 24, 48 hours, seeing some of the takes, some of the really thoughtfulness behind some of the remarks from people regarding the Helium decision. I think we're still figuring this out, right? I mean, when you look at DePIN, it's still pretty nascent, and Helium's done a great job of pioneering the way, and I think some of the metrics they've been hitting are pretty remarkable, really. So excited to see them trying new things. I think that the immediate reaction from people, maybe it could have been worded a little bit better from Amir also, but I think the immediate reaction maybe was a little bit overblown. So we'll kind of talk about that a little bit. By the way, if you're watching, make sure to like and share if you would. Make sure to subscribe to both our YouTube channels too if you don't already. But again, we'll be doing this once a month. So very exciting stuff. Tyler, I'm just curious, like, I guess we should just go into the elephant in the room, which is that announcement from Helium. So I don't know if you want to kind of do a high-level overview of exactly what happened in the timeline there, and then we kind of get into our thoughts.
Yeah, absolutely. So maybe just to level set, I can share my screen. Let me find the post that came from Amir directly. I don't want to actually misquote him in any capacity. Let's see. How do I?
Greetings. Well, you pull that up. We'll look at some of the comments here. Mr. Brian's in the house. How's it going, Brian?
Hello. By the way, Brad, I've got my tab pulled up, but I don't think I can actually share. There we go. Oh. So, yeah, I guess this was kind of the big announcement that we got from Amir yesterday. So just to summarize real quick, I guess I can read it verbatim, but he said, an update on HNT buybacks. The market doesn't seem to care about projects buying their own token back off the market, so we're going to stop wasting our money under the current conditions. Helium plus Mobile generated $3.4 million in October alone. I'd rather use that money to grow the business and pour it into a hole. We're fully focused on growing Helium Mobile, so on and so forth. So I think let me before I start diving into a couple of my takes, I had another post here. Where was it?
Can you zoom in a little bit on this? Like you're a little bit bigger on the screen.
Yeah. Let me do that.
Hey, awesome.
So this was one of the kind of my initial takeaways, because I obviously knew we were going to be chatting about this on stream today. But I think one of the takeaways from this and you alluded to this a bit, that I was really excited about was given the fact that my entire Twitter timeline seemed to all of a sudden wake up and give a fuck about something that I would argue has not been part of the conversation, maybe as significantly as it has been. And so I was maybe more optimistic than anything else, just to see how many people had opinions. And you had a great engagement with Amir specifically on this, and you got quite a few people responding. You had Kal Samani. You had Mike Dudas responding. So this wasn't just like in a chamber ecosystem conversation. This was happening across crypto. Obviously, we saw other big projects start talking about this as well. So I think the first thing I would just say is, this is an interesting position to be in now, where all of a sudden people are actually concerned, or they give a damn about what's going on. I think maybe one piece of this equation that we should clarify, and I don't know if everybody had the same takeaway or not, but this decision does not mean that they're going to stop burning, agency for data credits from revenue from carrier offload. This is specifically focused on the mobile side of the business, which is orthogonal. I know people make fun of me because I always use that word, but this is somewhat orthogonal to the Helium the Helium network specifically. So I have some thoughts. I think Connor, who does the Proof of Coverage pod, had one of the most thoughtful, kind of well-rounded responses that, in my opinion, kind of nails it on the head. I don't know if I have that up here. I just had looked at a couple different things. So, I think his take was really good, which is, it's understandable. Probably my first takeaway from this was that burning 100% of the revenue, and you and I have had a lot of these conversations, off stream, if you will, but burning 100% of the Helium mobile revenue is not sustainable. There's no way that it's going to materialize in kind of a long term. In my opinion, there's no way that they could sustain that long term. So I get it, and my general takeaway is that they're doing what they think is the right thing based on the feedback that they've gotten, or sort of the market feedback, if you will, in terms of price action. I know one of the things that you had posted was we're a little bit early because you had 1010, you had tax loss harvesting, you had a few of these other variables in there that were making this potentially a bad indicator of what they should do. But at the same time, I understand if I was in the position of being the CEO of Nova and I just spent $11 million to buy back my token and that wasn't materializing in the price, I would say, hey, this maybe isn't the best use of capital either.
Sure.
So those are a couple of my initial takes. There's a lot to unpack on this, and so we should probably take it bit by bit, just because it's not this black and white. Oh, they're just going to stop doing buybacks. It's quite a bit more nuanced than that. But I don't know. Do you have any initial takes to maybe add to this?
Yeah, I think it's important to look at it from all angles. I 100% agree. Like, from a mirror standpoint, you can tell in his tweet that he's very frustrated. Mm-hmm. I would be deflated a bit if I just sunk $11 million into open market buys, burning those tokens out of supply, literally throwing that capital into a black hole seemingly, because the price is down. So I understand his sentiment there for sure. And I think it does come down to, I don't think it's fair to say it had zero impact. I think maybe that's a hyperbole, but does it have material impact? And is there a better use case for that capital? I mean, you're running a business at the end of the day. So throwing $11 million is not nothing, man. That's a good sum of money that can be utilized for project growth. And I think you made a good point too. And we have talked about this. I think when they first made the change, everyone's and I was very excited about the announcement, but the one question that kept coming up is, if you're taking 100% of revenue, how are you going to keep the lights on at a certain point? You have to also have revenue to run your business, to invest in growth. I think for me, one of the frustrating aspects is that there's just this all or nothing approach, it seems, for a lot of people. You either have to do 100% or zero.
Yeah.
I don't see why it has to be so black and white. Why can't there be a hybrid approach of some sort? And this is something that Nick, with Blockworks, your business partner, brought up in one of the spaces when we talked about this earlier in the year, was you could have a graduated approach. I think in the early stages, especially, it's really important to reinvest capital. You don't see publicly traded companies or startups buying back ownership, buying back shares right off the bat. It's normally very mature businesses. So I think a graduated approach makes sense, where in the early stages, especially, you're able to reinvest capital. But there has to be some sort of, in my opinion, a set schedule that outlines how that shift would take place, meaning, over time, a portion of that revenue does go into open market buys. Because I think for investors, you need to have foresight. You can't just, trust. And I've seen a lot of people saying well, at some point they can go back to open market buys again when it makes sense. Well, that's not, for me as an investor, that doesn't give me confidence, in okay, when's that going to happen? Will it ever happen? What's the time frame there? So I think you run the risk here of turning away potential investors. You also run the risk of not giving people an incentive, especially deployers, an incentive to hold your token. So I think there's some risks there on that end, and ultimately just disconnecting the fundamentals from the token price. I think it's fair to say, if you look at the charts of most DePIN projects, and we'll call out one or two where it's not the case, but most of them look no different than a meme coin chart.
Yeah.
So
in a lot of cases, they almost look worse.
they in many cases they do. So it's like there's obviously a disconnect between the fundamentals and the token price. You can blame market conditions to an extent, like there's no doubt about that, but there should be some sort of a decoupling that's happening.
Yeah.
So I think you can look at that as, hey, something's broken and that needs to be fixed. So that's why one of the reasons I was super excited about Helium, trying this. Now, is 3 months a long enough period to try this out? I think you brought up a couple of really good points, and points that I brought up as well. Is like, okay, 3 months during the worst liquidation event in crypto history, and with end of year tax harvesting, that's you always see selling from. So
right,
at the point of him posting the announcement over, I believe it was a couple of days ago. I don't know, the days are running together at this point, but and then the original announcement that they put out in September, where they talked about both using 100% revenue for open market buybacks and burns, and they also had the digital asset treasury announcement in there. I think the token price was down maybe like 10%. Okay, yeah. I believe in that range. So I would argue that the token price probably would have been a lot lower if they weren't buying with $11 million. I think that's fair to say. I don't think it's as easy as saying, well, that's $11 million of extra sell pressure that would have been there. You and I talked about this. Like, there's certain people that probably would still be holding that maybe wouldn't have sold, but they used that buying pressure and that stability, liquidity to exit their positions that maybe wouldn't have otherwise. But
right,
I think you can definitively say the token price would be lower.
100%. 100%.
So, and then the other aspect though too is you had years of a precedent set where you had a lot of emissions. Those still need to be offset. I don't think it's fair to assume in 3 months of buying you're going to alleviate all that sell pressure. And they announced not long ago, I think in that 11 million includes that figure. I think it was like a little bit over $4 million where they bought out an early investor that had a huge sell wall. But there are a lot of whales that there are a lot of sell pressure from early emissions that have to be offset. That's going to take time. So I think that's kind of my frustration, is that they only gave it 3 months, and just the heavy-handed approach of going 100% down to zero versus trying something different. Now, one of Amir's responses I thought was interesting was he's like, we're not taking open market buys with Helium Mobile revenue completely off the table. We're willing to look at other options, maybe not burning those tokens, maybe storing them in a treasury for future use. I think that's interesting. Mm-hmm. You've put out a couple of interesting options as well. And I think we'll break through some of those, but I mean, that's kind of my main takeaway right now is, I think it's good though. I think it's good that we're having a constructive conversation about it and it's getting a lot of attention, and not just kind of in a vacuum like it has been, but we're seeing a lot more people participate in that conversation. I think that's healthy for the space.
Without question. And, I'd even said this in my post, and I say this all the time, which is that this entire thing, in my opinion, is one big case study, and we're trying to figure out exactly what the right approach is to making this all work. I wanted to highlight something that Trivia, whatever, said in the comment on YouTube. I don't know if you can highlight this, but I know Connor from the Proof of Coverage pod also had shared a kind of a similar take, which is, I think, a really important thing to underscore as it relates to how people think through, just move my desk, as how people think through kind of this role of tokens, which is, he had another one previously that said, we love a high level overview of how owning tokens the same differs from stock ownership. The case for owning tokens needs to be better explained. Mm-hmm. I think that's really important. And I think all of the people, I've got this post highlighted. I think that all the people that are looking at tokens as kind of this one-to-one mirror for equities, I think it's an incorrect way to approach it. I think I sent you this snippet of one of the articles or one of the research reports that's kind of this new valuation framework on DePIN tokens specifically. And the first line in the article, which is that they are a hybrid asset between a medium of exchange and sort of this quasi-equity like structure that's primarily used for incentives. The thing that differs is that you're in like a normal business where you like raise money and you give out stock options for early employees, RSUs, whatever it is. That has a fundamentally different value exchange mechanism where you've got kind of this independent revenue stream that could eventually be priced into the book value of like through a DCF, not necessarily the book value, but through like a DCF or any other valuation metric that gets applied to the equity side. That's not the case in DePIN tokens or tokens in general, because they function both as this medium of exchange as well as kind of a proxy for value. The difference is there's two things that I think are important to underscore. One is that the value distribution mechanism is not it's implicit in the way that the value accrues, meaning there's not a dividend that you have that's independent from kind of the equity appreciation price. And DePIN tokens specifically, the way that you achieve that is by removing tokens from supply as you've got additional revenue comes in. And so at some point, the value equation is like, what's the future value generated by the network denominated against the tokens? That's one piece of it. And then the other side is that you have this relationship where it's not a one-to-one to equities in the sense that you've got ownership control. You have none of those things. And so how do you actually start accruing that when you're giving out tokens on the front end of the network without the ability to be able to kind of offset some of those emissions, which are costs, by the way, like those are a real cost to the network. You're not ever able to offset that. So I think this comment here is really kind of insightful, which is, TradFi company earnings, which are shared as dividends, something that 99% is not happening in crypto. In this model, it's nowhere near 100%, often uses a mechanism to increase earnings per share. And I think this is the other thing that's really critical. And I know Mike Horton from GeoNet had something, which is that in a DePIN network, which differs from like a traditional corporate structure, what you have is you're taking kind of this incentive mechanism across the entire business versus where in like a normal corporate structure, all of the work and value accrual is specifically to the equity. And so it doesn't, in my opinion, make sense to make that comparison where you're buying back tokens on the early days, because if there's no incentive or sort of value accrual that comes for participants along the way, you're creating this like one-to-one with tokens and equity that just isn't a valid comparison, in my opinion. So that's kind of a long-winded answer. I lost my train of thought slightly through there. No. But at the end of the day, it's just not a reasonable comparison to make, I think.
It's not, and also protections. So, one of the things I was going to bring up here, and trivia, whatever, brought this up as well, is like, one is bankruptcy. And frankly, common shareholders generally aren't going to get much of anything in a bankruptcy filing anyway. But the other thing would be an acquisition. And this is something we're predicting will happen. We're actually seeing this with Dynex. Like Dynex is a project that is kind of leaving the crypto space and going to IPO. And there's a whole discussion around how do token holders get value out of that, or do they at all? There's no legal protection for token holders that in an acquisition or something of that nature that they would get any value, versus a stockholder. You have those protections. So you're not legally an equity holder in the company, and right. I think that's why it's so important to have value accrual to the token in some way, shape, or form. There's a lot of different ways that can happen. But in my opinion, if you're running a business, in these projects and DePIN are businesses, or they should be, if they're not generating profits or have a business case, then they're just using the DePIN acronym and they're not an actual DePIN project. But you're running a business, and then on the side, and I think I would argue even if you're burning out of a treasury, if you're not buying in the open market and creating buying pressure and bringing outside revenue to become a new buyer, to me, it's the token becomes a glorified meme coin, man. Like
100%.
There's no connection to the fundamentals. Why would you want to buy a token then? And I think that's the main takeaway for me. And I think there's different ways that accrual can happen. And I'm excited to see some ideas, things that I had certainly not thought about before that, just in the last 24, 48 hours has popped up as a potential mechanism to do that. You had some really good ones, I thought, with, staking and kind of a dividend yield model. but I agree. Like Mike Horton was, talking about how your token holders are the ones paying and building out your infrastructure.
100%.
That's a fundamental difference as well. But and I've seen a lot of people also that are talking about, as far as being an equity holder, if you're holding stock versus tokens, they're like, well, when the market structuring bill gets passed, let's just like cross our fingers that this gets figured out. I'm like, shit, man. Like, I'm not interested in investing in something and holding and crossing my fingers and holding my breath. I'm not as optimistic about the market structure bill getting passed as a lot of people are. I mean, the betting markets, I think right now have 89% chance of it happening this year, but it's a midterm year, man. Like, we could see this thing get pushed out and get kind of messy, especially with some of the rhetoric around crypto, with some of the stuff Trump's done with the meme coin, et cetera. They're still trying to go back to change some of the language around the stablecoin bill right now.
Yeah.
So I hope it gets passed, but I don't know that it's going to, and it might be later in the year before it does. Hopefully that's not true. But
right.
I think we need, as an investor, you need definitive answers and you need clarity. And I think right now we don't have a ton of that.
I totally agree with you. And by the way, another thing that you've got pulled up here is if I own shares in a company and Apple buys them, I have value. No one knows what happens in a company if you buy a DePIN. One of the things that's kind of interesting is that we actually do have some precedent around this. There was a wallet company that was acquired by Stripe. Sorry, there was an opco for a decentralized protocol that was you could like scan a QR code and do payments and all this kind of good stuff. They acquired the opco. They didn't acquire any of the token of the network. It was literally just the people behind it. Coinbase had something similar recently where they acquired a team that had built some wallet infrastructure. And so the token like tanked overnight. And I think that's an important thing to underscore, is that you don't have the same protection mechanisms in place. I think what Mike says here is really important, which is it's an incentive mechanism and it's code, right? But going back to the kind of maybe the rationale for having buybacks or some value mechanism that accrues to the token ahead of what would otherwise be considered normal in the traditional cycle is, and he says it really succinctly, which is Web3 projects use code to monetize a business, including the incentives, incentivizing others to deploy traditional CapEx and OpEx resources. For a decentralized network, deploying CapEx and OpEx resources is programmatically rewarded with the network's utility token to reliable suppliers. I think this is the most critical reason for why this kind of argument for early, if you want to call it early, buyback mechanisms are so important, because it's a fundamentally different model than what you have in like a traditional corporate structure. And as a result of that, I think that there needs to be kind of that earlier value distribution, however that gets materialized back to these token holders. Otherwise, you're effectively taking you're just putting the risk on all of these speculators that are pricing tokens on the margin. And when you have that, you're able to, effectively circumvent the traditional cost of growth. And it's long-term, it's very unfair for these participants. So if you don't have that in place, it's just a net loss. I think the other thing that you called out, which I have in the valuation framework, which is there is what a token should be worth, and you can argue kind of based on future expectations. But the other thing that's a very real factor in all of this is that you've got kind of the value that it should be, but tokens are priced, and every commodity or even asset is priced based on trading volume. And so when you've got thin liquidity in markets, or you've got kind of this net sell imbalance between the people that are interested in acquiring the token and those that are just getting it as a reward distribution mechanism and then dumping it, you're going to see a massive disconnect between what the fundamental value should be and then what it's actually being priced at, because of, again, market dynamics. Like this is more economic theory than it is financial theory, which is that, if you print a bunch of money into an economy, you're going to have value decrease or value that gets sucked out. And then in conjunction to that, you've got market dynamics that are pricing things completely in a disjointed reality from what the value is. And so I think the argument for these open market buys is, one of it is that you've got this implicit value distribution through, again, in a perfectly balanced market, this should increase value, right? Because if you think the network's going to generate $10 million and that's priced against 10 million tokens, the token value should be more than if there was 100 million tokens substantiating the $10 million in revenue. But At the end of the day, what you're seeing right now is, and again, this is the argument for the buybacks, is that you're having a net sell pressure environment where that buy pressure, maybe it's not moving the needle as much in terms of the value distribution as much as it is offsetting those forced seller rewards. That's helping create some equilibrium, back to your point earlier where it was, what would the price action be if they hadn't put $11 million? I think the argument would be that the token's going to be less because that buy pressure is offsetting the sell pressure from somewhere, right? It's not going into a black hole. And so especially in these DePIN networks where you've got this ongoing supply emissions that are being sold into the market, that has to be mitigated in some context. And I think the way that you mitigate that is open market buys.
I agree. Now, as far as the burning aspect, though, you could argue that is kind of going into a black hole. It's offsetting seller pressure, but then those tokens are gone forever. Whereas I think there are some interesting models, like you will go through yours. Like you could use it for potential future dividend payouts to token holders and entice them to stake, which would further offset sell pressure. Reinvest for growth. A couple of things though, a couple of comments here that I think are interesting. One is I always assume DePIN projects required users of data to operate within the token world. If you use GeoNet data, you'd have to buy GeoD tokens. So in essence, that is what's happening with GeoNet, but it's not, they don't force them to go and buy GeoD tokens because they have a lot of Web2 customers, man. They want to simplify it to allow people to use US dollars. But they are very transparently on the back end. GeoNet's from day one taking 80% of revenue, purchase tokens in the open market on chain, and they do it small, frequent purchases so you can't game the market, because some of these projects were doing at the same time every week mass purchases. People could kind of trade that.
Run that, yeah.
Exactly. So they are. I think GeoNet's a great example of a project that has been doing this from day one. And it's an important distinction to make because, again, if you go multiple years of burning out of a treasury and have all these emissions and then all of a sudden change your token model to start doing open market buys, you need to let that play out. And this is something we're seeing in general with token prices, and why a lot of these charts look the way they do. I think it's because there's so many emissions up front that you have to eventually offset that and find an equilibrium, to your point, Tyler. Now, I will say, when you look at GeoNet's chart, okay, it's not like necessarily, remove this and add this here. It's not necessarily like the prettiest chart in the world, but it looks a lot better than the other charts out there. So you're going to, look, it's an early stage industry. You're going to have inefficiencies in markets, right? Where things get overvalued and undervalued. But we're looking at a retracement of, I think, about 40% from the all-time high versus 90, 95% for a lot of these projects. And I think that the stabilizing factor for GeoNet has been open market buys from day one, and very transparent as well. And I think that goes into something that Connor posted, and he has this at the top of his profile. He's a pinned, guys. But he talks about investor relations, IR, and how that's so important. And he gives some great examples of projects that have been very transparent about their tokenomics and accruing value to token holders. And he gives some examples here. Early IR leaders. So Maple Finance, for example, they're crushing it, guys. Like in a year where market conditions have been horrible, they're performing quite well. And it says there's no equity vehicle, but they're focused solely on their token, committed to monthly buybacks funded by up to 25% of protocol revenue. Okay, so he gives us plenty of examples here where open market buys have had a positive impact. So I think it's one of the things that is a danger in what we've seen with this announcement, and you and I have talked about this, is if Helium has led the way. If this is now interpreted from projects that, okay, well, buybacks, open market buybacks don't work, that I think is a dangerous precedent to set, because I don't think that you can definitively say that after a 3-month trial period. And I think that's the risk, is that now other projects will be unwilling to try this. Because HiMap is a great example. Like shortly after they announced very transparently that they were doing open market buys. I think if we start seeing projects ditch that now, I think that's potentially a bad thing for the space as well.
Yeah, I agree with you. And I think that the unfortunate fallout to your point is going to be a lot of people who are just copy pasting the Helium playbook, and they're like, well, if it didn't work for Helium, it's not going to work for us, and therefore we shouldn't do it. And so one of the things that you and I had chatted about offline is it would be interesting to kind of, it's hard to do, but it'd be interesting to model what the price would be at if you didn't have this initial $11 million kind of capital that was flowing back into the token, and just do a comparison of that. Because I think, again, the thing that people take for granted, and I've really come around on this, which is I used to think that it was all about what's the net amount of tokens out there. And the reality is the net buy sell pressure, which is also impacted by liquidity, is the number one thing that impacts price action. And then the secondary fact of that is, once you've got kind of a market that is working the way you should, efficient market, if you want to call it that, then the other factors play a role. And so if you don't have that buy pressure and you don't have enough speculators that are going to be able to kind of offset, again, what is net sell pressure coming into the market, then you're going to see a price decrease. And so I would love to again, it'd be a little bit difficult to do, but it'd be really interesting to see if you took that $11 million out, or maybe call it $6 million out of the that flew into the token, what would that have done to the price? And I would argue it would have created downward pressure that hasn't materialized because of the fact that they were buying these tokens.
There's no doubt. I mean, just mathematically, like that buy pressure obviously offset sell pressure. The token price would have been lower. It's just hard to model because, again, there are token holders that likely use that opportunity to exit the positions, and they're willing to sell it maybe, $2, or what is that, $2.20. Without that buy pressure, we probably wouldn't have gotten there. So they might have still been holders at this point. So it's just really hard to model what the price would be. I mean, you could run scenarios though, for sure, and at least get a range that's high probability range. But it still comes down to the question of, as a business owner, is that the best use of capital? Like, is it a material impact? And I would argue probably not. The fact that the price was down 100% of revenue, probably not.
Yeah.
So is there a mix that makes sense? I think probably. And I think, you can look at certain things like the net deflationary price, like at what price point, and Helium, I think, was, last I looked, like $2.47. Anything below that price, you're net deflationary. As you get above that price, obviously you're not. But I think that's kind of an equilibrium that's interesting to look at. And I think you could make the argument that if you're below that price and you're net deflationary, your token price is undervalued, maybe, but that's certainly a mechanism you can look at. And I think market conditions are playing into this a lot, but I think there has to be a accrual mechanism to the token. And really, for me, looking at projects going forward, like, I'm not interested in owning a token if there's not. And if I'm mining a token, I'm going to sell it as soon as I earn it if there's not an value accrual. And if they introduce it at a later date, then I'll be interested in buying the token as an investment. But until that would happen, I just don't see the value personally, unless something really changes as far as like equity ownership and legal rights there.
100%. And the risk to, I know you called it kind of no different than a meme coin earlier. That's the reality of it, right? The risk is that the only way that you see the price appreciation is speculators that are offsetting all the suppliers that are doing the same thing that you're talking about, which is just dumping the token right when they get it. So, by the way, 619 said, who's copying Helium? Doesn't everyone say we learn from Helium's mistakes and do it better?
That's copying in one sense, is avoiding mistakes Helium's made. I mean, I think it's like, none of this conversation is to take away from what Helium's been able to achieve. I mean, it's freaking nuts if you think about it. Like, they came out with the token incentive model. We had no idea if they'd be able to build out a network. I think it was a lot more effective than they had anticipated. Anyone could have anticipated. Obviously, it was time with the bull market, in the last market cycle, but still, like, that's nuts. They started off in IoT, which obviously wasn't going to generate enough revenue. I mean, they went, like, Forbes was like dogging them. I mean, they had so much FUD around them, and they were able to pivot effectively. They were able to find product market fit. They're working with AT&T. They're expanding into Mexico and Brazil. Like, I mean, they've done a lot right, and considering they're writing the playbook. So I think that you can't take that away from helium. I think we're still kind of figuring things out here, but yeah, man, I think they're a great example for other projects, both the good and the bad.
Yeah, I would certainly echo your sentiment there. I mean, I think we've published like 67 or 68 different founder interviews. Some of them are repeats, but at least 50 different projects, and almost every single one of them took inspiration from helium. They are the kind of the grandfathers of the space. Not to use that as a pejorative, but they were really the ones that set the tone for this model. And I think the downstream effect of that was that some people did look at what they pulled off, and they said, well, what are ways that we can iterate on this approach? I think GeoNet's maybe a pretty good example, specifically with the changes that they made, where we're looking at how to balance the supply emissions a little bit differently. I think that's one way where they led, but you had a ton of other companies that just blatantly copied the model. And I think the lion's share of like the long tail of projects, they just said, oh, look, helium was able to do this for IoT or mobile. We could do this for XYZ vertical. And so they didn't really iterate too significantly. The thing that helium's been able to do well, and we've said this a lot, and they deserve a lot of credit for it, is that they were able to figure out this isn't working, and they could pivot. Now, whether you agree with the pivot or not, at least they were forward thinking enough to say we need to make some changes. And in a lot of cases, I'd argue projects either haven't been able to have like a retrospective and say that we should do something a little bit differently, or they blatantly copied helium. Some good, some bad. Like I'll use the HiveMapper case. They started doing the open market buys pretty soon after helium announced it. I think that was a good thing. I would almost bet money on it that in the next few weeks, you see HiveMapper go the same approach, where they're like, oh, we're no longer going to do open market buys. I could be wrong. I'm not disparaging them. I just feel like they're going to see what's happening with the HNT price, and they're going to say, why are we burning all of this revenue when we could just burn it out of treasury? I don't know if they still have treasury tokens to do that, but I think that is one risk, which is helium is the leader, and people look at that as a indicator, for better for worse, for what they should do within their token. And if they see the number one project spending a shit ton of money on buybacks, and they're like, you know what, we're gonna retool this or rethink this, that's maybe going to be a driver in seeing other projects do something similar.
Yeah, I hope you're wrong, but again, I mean, this is something we've talked about a bit. Is like, I do think that other projects could follow this lead and just like throw in the towel. And I think that, again, that's a dangerous precedent because, as we talked about, I don't think that we learned much from this. Like a 3-month period with everything going on that we're seeing in the market right now. I just don't think that we learned enough to have any definitive view on whether or not this is effective, man. Like, I don't know. But yeah, HiveMapper, one thing I do want to bring up with HiveMapper, actually, because there's a comment back here that says, HiveMapper needs to get a lesson. Your community is your source of data revenue. It's true. Now, one thing they are doing, though, and this kind of goes is a little bit different than what Horton was talking about, is they raised funding recently and were able to get rid of the upfront cost. So they basically have a lot of that financing is allowing people to pay a monthly payment versus having to come up with that capital on the front end. So that's kind of an interesting approach. I don't know how effective it's been because obviously market conditions have been absolute dog shit, but it is an approach that Rover is also taking with their staking program, where you stake tokens, they send you equipment, you map with it, and then you get your stake back. So at the end of the day, you're just earning tokens for contributing without having to lay out the capital. I mean, you lay it out, but in the form of staking, you get that stake back. I think we're going to have to see more and more projects do that because people don't have the capital in a lot of cases to dish out, especially if you're setting up like a huge deployment company. And I think just with like what we've seen with some of these DePIN tokens, man, like it's also the staking. It's an effective way to create buy pressure and remove sell pressure as well. So I'm curious to see how that works out for Rover, but I wanted to call out that change there because it's something we hadn't really seen until recently.
Yeah, so I haven't been following what they're doing as closely as I have with some of these other projects, just because A, I don't have as much exposure to Hivemapper. I bought a bee. My brother-in-law was gonna drive around and use it, but I think that they have innovated to some degree in terms of the way that they're approaching how all of this works. But I'm not. You're certainly a better indicator on the Hivemapper stuff, just because you're that was your bread and butter for quite a while there, right, Brad?
Did pretty well on Hivemapper in the early stages. Yeah, that I mean, like that. Another thing with Helium, being an example, these other projects, and you kind of mentioned this, like you and I both interviewed a lot of the top founders of projects across DePIN. Almost all of them drew inspiration from Helium in some way, shape, or form. Like I don't even think that the DePIN sector would probably be here at this point.
No,
At least not nearly to the extent that it is without Helium. Hivemapper is an example of that, right? I mean, some of the Helium early investors in Helium are also early investors in Hivemapper. So, I mean, and I'm the same. Like I got involved in DePIN because of Helium. I built out a deployment business there, and then realized, okay, there's gonna be other DePIN projects. So, copied that model that I had created for deployments with, Demo, with Hivemapper, with WeatherXM, just to name a few. And then, built out like 100 vehicle fleet of Uber and Lyft drivers with Hivemapper in the very early stages. I put pre-orders in like the first day they opened. So, you see that you can do really well with these projects, especially if you're early, you take on the risk at the front end and help them build out the protocol. And I would say, like, from a customer acquisition standpoint, Hivemapper's done a great job. I mean, they're working with the likes of Lyft.
they've probably
Volkswagen.
Yeah, they've probably done the best job at attracting really, really big companies to be a participant on the, kind of the demand side of their business. More than it's hard with a model like Helium. There's only so many MNOs that you can tap into, and then you have to start expanding, horizontally outside of the US, and they're doing that now. But I think the Hivemapper case in particular, in terms of their customer announcements, has been probably the most notable in both traction and names that we've seen, which is, I think that's cool
For
to have
sure.
happen.
I'll get in, James said getting in early with Helium hardware shit show. Yeah, dude, I got totally effed with the Nebra situation, man. Like, pull out. Like, I got totally screwed. It left a sour taste in my mouth for like a long time with DePIN, but I still forged ahead, and I'm glad I did. Like, did very, very well in building up these deployment businesses, especially as we saw things kind of tick up in 2024. The big problem, though, and this is still something that needs to be addressed, and I think it's pertinent to this conversation, is, yeah, you can get in early, you can build out deployment business, you can help build out their business case and do very well, but we need to stop seeing the charts completely relying on hype. These charts need to start decoupling. We need to see price decoupling from all other alts. And I have to say, like, I think we still are trying to figure this out, obviously. Like, how do you make sure that the fundamentals are connected in some way, shape, or form to the token price? Because the way we're running right now is, for one, you can't run a business that way. Like, you can't get consistent contribution if your token price is freaking going crazy, and you have down periods for extended periods of time. Like, it's already difficult enough to have a startup and do all the things you have to do to build up a startup, including finding product market fit. Sometimes you have to pivot, the revenue side of things, while also balancing the crypto aspects and crypto-minded people, which, let's be real, like, they don't understand that these are startups. Like, people, I think, have way too high of expectations for early stage businesses than what is reasonable, in my opinion. So, like, that, you're dealing with a lot there. So the volatility just adds a whole another element of difficulty. And I think we've got to see that part change, man. Like, we really, really do. And I think that's why, like, calling out GeoNet is a pretty solid example of, I think, a project that's done at least better than others.
100%. Yeah, I couldn't agree more. I think they've done everything right, from, not over supplying token emissions by being really intentional on kind of both the quality of deployments and also ensuring that it actually is a driver to ensuring revenue. And then obviously they've been able to match that with customers who are paying for it. So they've really checked every box. And I know I've said this on a couple different streams, but I think one of the things that makes the helium use case or the case study a bit difficult is that, at some point, you have to factor in the reality that they emitted tokens to build the IoT network that hasn't really materialized anything. And then they sort of pivoted that into the mobile network, which is starting to happen. But you called this out earlier, which is that emitted value has to be offset in some way. Like, this isn't free funny money that just gets to be used as kind of this speculator driven value mechanism to get people to want to participate. It is a real value that a lot of times I think, and maybe this isn't a conscious decision, but projects are doing what they think is the right value distribution based on whatever parameterized factors they're looking at. But it's really hard to discount that, at least with helium, you've got so much value that it's been put out into the market. It's going to take materially more revenue flowing back into the token to be able to find that equilibrium than I think we've seen. Like, if you look at GeoNet, for example, right now, we were just checking this out ahead of stream. They're at 7. I'm not a big fan of the price to sales ratio and how you price these tokens, but if you wanted to use that as like a metric, right? They're at 60 mil market cap, 7 mil revenue. That's not a unreasonable multiple based off the revenue that's coming in. And they've got continual buys. They've got a decreasing emissions curve that isn't, again, it hasn't been front loaded so drastically that like that disparity is hard to maintain. And so I think it's, I don't know that you can really have a material impact on the HNT side without seeing revenue that's going to get closer to that relationship of hundreds and hundreds of millions of value that has been dispersed to participants ahead of this revenue coming in.
Yeah, and to further that point, you look at like the circulating supply for GeoNet, 43.8% of their tokens, and they're years into the project. There's some changes I would like to see from that front. And I think, helium, again, they didn't know if it would work. So they had heavy incentives early on. I think we're maturing enough to where projects can be a little bit more thoughtful. I think we've proven out that token incentives work to get people to participate. I think we're going to see projects become a lot more thoughtful as far as early stage emissions to kind of level that out a little bit more. The other thing I would really like to see is token unlocks you can't really do this so much for investors probably, but the early stage investors, seed rounds. But I think for employee unlocks and the team unlocks, they should be tied to milestones, because as a contributor, the more value you're bringing to the network and growing that, there should be alignment there in the amount of tokens you receive. I think the team should be held to the same standard, in my opinion. They should have certain milestones they have to hit certain token unlocks. It shouldn't just be on a set schedule. Because what we're seeing right now is, a lot of these projects, after 2 or 3 years, normally with like a 1-year cliff up front, they're fully unlocked on all their tokens. And we're going to start getting to a point now where we're going to see, like, are these founders going to be super motivated to keep moving things forward? I think they will to keep their token price up. But once they exit, what does that mean for the project? I think, if you have a 15, 20, 30 year, in some case, distribution schedule for contributors, I'm not saying that the team should be held to that long of an unlock period, but I think it should be longer than 2 or 3 years. And again, tied to their contribution to hitting milestones, because the contributors can only control so much, whether it's collecting data, whether it's building out the network. The team has to execute on the other end of it. And I think that there has to be some accountability there as well.
Yeah, I think you're so spot on. And that's one of the kind of tokenomic revisions I hope does become more of a considering or determining factor within these different projects. I know DePIN hasn't had their TGE. I'm not sure when that's going to happen, but they're one of the few projects that I initially was excited about how their tokenomics were structured, specifically related to the team rewards, where they were 100% predicated on various milestones. And they weren't just like bullshit milestones either. They were like, we need this amount of revenue flowing into the network. We need this amount of supply to be able to support that revenue coming in. And so it was very much aligned with every other participant within the network. And so this arbitrary, 4-year vesting schedule, 1-year cliff that you see in traditional equity is, I just don't think it's a good proxy for two reasons. Number one, the timeline of these build outs generally, as we've seen within the Helium case, will take more than that. And the other thing too is that, I know that there's an increasing appetite or reception for these secondary markets for private companies, but in crypto, you've got the ability to start selling from day one. And so, in a traditional startup where maybe your equity is vested over 4 years, if your liquidity event doesn't come until an acquisition that's maybe 8 or 10 years down the road, if you want to see that materialize, you're probably going to continue to be incentivized to build the company out so that you can actually have that liquidity event. And in crypto, you've got liquidity from day one as soon as the token goes live. So anything that's been unlocked, you're able to sell, and that creates a disincentivized or a disincentive for kind of the long-term viability. And obviously operators that are wanting to make this work, like they're going to keep seeing it through. I'm sure that I know the HNT guys or the Helium guys have made a crap load of money, and they're still working on this, so they haven't completely sold out. But there's enough people out there that are like, wow, I've just made so much money from the token ripping. Why do I want to keep building this business? It's enough for me to just sit back and sip Mai Tais on the beach. So I really do echo your sentiment that I hope we start seeing kind of a more thoughtful approach to the team, founder, even other contributors as it relates to the token rewards that they receive in these networks.
It also helps stabilize price because it reduces the amount of sell pressure potentially in the earlier stages. So I think it does a lot, right, for the long-term stability of the project. And I think it's also fair to point out, okay, with Ario, they have beam apps, right? And other companies can do that. They can build a business on top of high mapper data and go and get customers. So, they're generating revenue from beam apps. So you make money off that. He needs the underlying protocol to continue working and collecting data for that to happen. So I think there's still plenty of reason for him, for example, to be working hard and wanting things to succeed. But I think we are seeing other projects, man, that some of them are out of business. They got their tokens early, they sold, kind of rugged everybody, and you're just kind of gone. And I think it's really important to avoid that. I do want to move into some potential solutions, though, because it's one thing to digest and bitch about things. And I will say, we see a lot of that in the community where people just want to complain. I think there's nothing more frustrating. I've managed people. Being a business owner, hearing people complain is one thing. Presenting solutions is another thing. So I think it's important for us to also look at some of the potential solutions that have been presented and get some thoughts on those. So I know you had this one pulled up, Tyler.
Yeah. So this was one kind of revised tokenomics framework that Nick and I have published. It's called Stake and Stable. It's a longer article that kind of goes through the challenges or the drawbacks with a burn and mint or a buyback and burn. And so this was a way to address a couple of the problems which we're seeing. And most of those are, you get a lot of value up front. If the token price just absolutely skyrockets and it's so disconnected from fundamentals because of, memetics or whatever it is in the market, then you don't have this kind of continued incentive to participate. And then the other thing is really not having a clean way to do the value distribution, as we talked about earlier. Right now, the only way to really materialize that value back into the token is through taking revenue that the network generates and flowing that back in one shape or form. And of course, there's different models that do that. But this way is a little bit cleaner, which we've kind of called the stake and stable model. And so effectively, the way that it works is that supply participants, you've got a logarithmic emission curve, and you earn each epoch proportional to your contribution. The idea would be that those tokens become something that you could sell, but more importantly, you'd want to stake. And so all of the protocol revenue that's generated gets distributed into some stablecoin pool, where if you've got, call it 10% of the stake, you would earn 10% of that distribution. And so one of the things that I liked about this model, there's a couple things. The first is that it retains that initial supply incentive, or incentive for the supply participants to participate out ahead of the revenue actually materializing in the network. The other thing is that I think it creates a slightly cleaner distribution model, because all of a sudden you can, say, hey, look, if they're going to generate $20 million in revenue and 80% of that flows into this pool, whatever my percentage of that is, I can approximate what I'm going to earn. The other thing that I really like about it is that from a valuation standpoint, which I know not everybody cares about, but to me, it's, I think, a really interesting part of crypto is like, how do you value these things? It creates a far more straightforward approach because you know what the tokens being emitted are. You can maybe approximate how much of that is going to be staked versus sold. And then if you build a model around, well, their revenues increased, it's doubled every year, and we think they're going to get X% of the TAM, you can use a more straightforward, like a Gordon growth model, to be able to value what that token price should be. So this was one way that I had thought about trying to address some of the challenges that we're seeing. Of course, like, and I think I had this pulled up, which was, I might have removed it, but Noah from the foundation had said, well, there's a couple challenges with this. The number one challenge is that it wouldn't actually work very well in a existing model like you have with a burn and mint equilibrium. Like, you'd have to fundamentally redo the tokenomics model, where instead of like burning HNT for data credits, companies are maybe just buying that directly, and so the HNT specifically becomes a reward mechanism that could unlock the revenue being generated. So I understand that that's a challenge or a drawback, but I think for new companies that are entering the space, this could be an interesting way to kind of manage a few of those different variables that have historically been a challenge for companies as they scale.
I think it's an interesting thought. I mean, I hadn't thought of this, and I think it makes a lot of sense. It definitely gives you a lot of incentive to want to hold and stake. And I think if you're getting a distribution of stable coins, like, that's super interesting. The question, of course, is, okay, like, what percentage of revenue goes to that pool versus is retained for growth?
Yeah.
And whether that's 80 or 80%, 20%, like what GeoNet's doing, I actually would argue that probably GeoNet, maybe 80% was a little bit too much in the front end to going to burns in that case. In this case, it'd be redistributed to token holders and stakers. But I like the concept because that's a clear reason to want to hold a token or invest in a token. And of course, then it comes down to the fundamentals. Like, are you correct? Are they able to execute and generate revenue? Is there a lot of revenue growth? I mean, that becomes more and more enticing to want to hold the token if you're going to get a larger and larger share of stable coins based on the success of the business. So I think that's a fantastic idea. It's just a matter of how do you iterate? Like, what does that mix look like? Is there more? Do you get a higher percentage for the longer you stake, et cetera? Like, there's certain things you can work out in the details there, but overall, I really like the concept.
Yeah, I appreciate that. I think it's an interesting kind of variation or deviation. The other thing that Nick and I talked about, Nick expanded on this on one of your streams, and this works more for like the not the burn and mint, but a buyback and burn model, which is that you've got a KPI driven percentage at which you're buying from your revenue. And so this could be logically thought out based on how much you think it's going to cost to grow the business, how much it's going to cost to acquire customers, so on and so forth. But effectively, it would be like, all right, for the first $10 million in revenue, this is just totally arbitrary. We're going to burn 30, we're going to buy back and burn 30% of the revenue. Once it hits 20, we'll up that to 50%. And so this helps, maybe as again, completely separate from the stake and stable model, but something that could address the challenge that these companies have, in the sense that they need money to fund growth. No one's naive to the fact that they actually need that money. So this could be one interesting way to help ensure that both the token holders are aligned with the kind of the longevity of the project, but also that the projects themselves have sufficient runway or operating capital to be able to grow it, because that's going to be a net benefit to the token holders, assuming the value distributes itself back. So I think those are two maybe interesting ideas. And I know we kicked off the stream and you had shared something similar, which is, this is, in the Helium case, this was a bit knee-jerk. Could they have done kind of a reduction, or looked at, instead of 100%, maybe it was 50% of the Helium mobile revenue? I think those kinds of mechanisms are interesting ways to have your cake and eat it too, if you will, with respect to having money for growth, but also ensuring that value does distribute itself back to the token in some capacity.
Yeah, like a graduated approach. I'll see if I can find that tweak, because I did respond. One other thing, though, I want to call out here, and this is something we haven't brought up, but something that is really important, and I think us in the community don't have to think about this stuff, but they also have to raise funding and investment, right? And in these investment rounds, you have to consider that those investors don't want to see them throwing money into a black hole. Like they want to see them reinvesting for growth. So the more heavy-handed you are in kind of throwing away revenue, I think the harder it is to raise capital. So that's something that you have to also take into consideration here that I don't think a lot of people think about, and we think about it as token holders. Like we think, oh, what are we going to do to support the token price? And that's also very important. But there are other things here that you have to take into consideration. And raising funding is incredibly important for runway. You're not going to make it without the ability to do that. So I think that's something that people also need to take into consideration.
Yeah, it can feel contentious at times because the value accrual mechanisms can bifurcate between the opco and then the actual network. And ideally, the opco is incentivized enough to have the value accrue to the network where they disproportionately create upside for themselves outside of any of the equity value in the token. But this has been, even back since the kind of the ICO craze, right? Like this has always been the contention because you've got a foundation that's quasi stewarding the network, and more often than not, that's more smoke and mirrors than it is actual, value being created or kind of operational mechanisms being in place. And then you've got this opco who is doing the legwork, who is raising the money, who does have competing incentives, and ideally those are somewhat aligned by having token side letters for their VCs so that they can accrue the majority of the value there. But this is not something that's new, and I know that there's new models. I know Connor had posted a couple things about this of sort of like a equity like token that could encapsulate the opco value and also protocol token rewards. I think that's interesting. I've not done enough diligence or research to really speak on it, but I think that there's ways that they could maybe address that in the future that haven't been handled now. Part of that's going to be regulatory based too, right? Because a lot of this has always been, you can't just sell tokens to a foundation or an opco that's going to build it in the US, and so you have to have this kind of arduous process of setting up a company, and you've got to set up like a offshore foundation potential. Anyway, so it's very convoluted, and that's something that regulatory clarity could hopefully address or improve upon in some way, shape, or form. But it's not been super clean to date.
Yeah, no doubt about it. I think the market structure bill could help a lot with that, but it's not passed. So it's not like I don't believe we can just like put everything on hold and just go about business as usual with the way these charts are looking and just say, well, once the market structure bill gets passed, we'll figure it out. Like that, to me, that's not a good strategy. And it doesn't give me confidence as an investor in these different projects that are like, oh, we'll figure it out later. Like I would rather than sell your token and invest in a project like GeoNet that is very clear in what they're doing personally. But here's like a couple of ideas for the hybrid approach. And obviously, there's holes. I'm sure you can poke through this stuff, but one would be a graduated model. So in the very beginning stages, in the early stages of a startup, like you need to really be able to reinvest. So in that early stage development, all of the revenue would be going to reinvesting. And then over time, as the project matures, as you hit certain milestones, those milestones, it would depend on the project, obviously, but over time, you would see that a certain percentage and a growing percentage would go towards open market buys. Less and less would be going towards reinvestment. But at the same time, your overall revenue should be growing. So even if it is a smaller percentage, it still could be a growing overall dollar amount that's going to growth. Of course, the problem with this would be it's not easy to copy and paste. It's going to have to be very project specific, and it's not going to be something that's just easily deployed in a cookie cutter way, right? So it takes a little bit of thought, but I think it's interesting. I think it allows you to grow, but also gives investors, at least in the tokenomics, they know definitively what's going to trigger, open market buys. And at what point is that going to happen? I think that's the clarity you need as an investor. The other one I threw out there was like a net neutral approach. So if you're net deflationary, well, that would mean that the token price is so low that your revenue is burning more tokens than you're emitting. Okay, in my opinion, that would mean the token needs support, needs price support of its price. that would kick in more aggressive market buys until that price is up to a point where you're net neutral at least. And then you can kind of back off that and retain more for reinvestment. So it's really just kicks in when you need that support of the token price. I think that gives you more of a level price that can help with contribution. So you have more consistent contributors. You don't have as much on the as much fluctuation on price. So just a couple of things. I mean, there's something Amir said in here about how he doesn't, I don't have it here, but he basically said like, hey, look, like we're not completely opposed to open market buys. It's just that we don't necessarily think that burning them all and throwing that into a black hole is the best choice. Maybe that means that we stack that into the treasury to use at a later date for growth, for incentives, to drive more participation. And that was kind of his response to Kyle Samani. Was like, hey, Kyle was like, buy low and sell high. And he's like, well, we can't really sell high if we're burning those tokens we're buying. And I hear that. So I have talked to a couple of project founders that are thinking about that model. Like, hey, we're going to do open market buys, but we're going to retain those tokens. Some of those will be used as like a dividend, like kind of like in line with your model where, those are distributed to, contributors that maybe are staking their tokens. Or it's used, maybe it's voted on and used in a way that can subsidize hardware to make it easier to, expand or run certain grants. I think that's interesting. And I think for their investors in investment rounds, I think that would be looked at a lot better than just burning tokens, frankly. Just kind of wrapping my head around that.
Yeah, I think all of those are good ideas and things that people should, and I think they are looking at as ways to kind of increase the ultimate value that's being created and then distributed. My only, and I don't disagree on the fact that, burning the tokens are just effectively evaporating it from thin air or sort of evaporating value, and there couldn't be better things to do with it. I do think though that the one caveat with that is you look at, again, this is where the equity model kind of breaks down, is that these tokens are also a medium of exchange in an economy. And when you've got a lesser amount of tokens that are being that are there, while you can argue that this would be like taking money and lighting it on fire, you could also argue that this would eventually increase the value to the remaining holders. And so that's just a cost of doing business. Again, there could be other ways, but if you delineate that value to other participants at some future point, you do have to account for the fact that needs to get absorbed by the market somewhere. So if there's enough speculation, certainly, maybe that could be done, but that is also a little bit of a tricky balancing act. And I don't know how you navigate those waters necessarily. But I also agree that the idea of funding supply incentives with some of that is a really great way, because it does help kick the flywheel off of additional participants that can generate more revenue. And that's kind of a good flywheel too.
Certainly. I mean, look, I would argue that it's probably better to have the sell pressure later when revenue is higher to offset more of that sell pressure than early on when you're still building out your protocol. So I think that you can absorb that sell pressure if you're effectively building out your project and your revenue is growing like it should be.
Yeah,
I would argue that sell pressure can be absorbed better later than in the early stages. And the token price can withstand that a little bit better later. And if it can't, and you're not growing your revenue, well, then your project's kind of effed anyway. Like, obviously, you're not doing a good job. What do you think about this comment? Open market buys goes to the middleman fees.
I think that's going to be true. I don't know what your.
I mean, Solana is pretty cheap to transact on, if that's what you mean, or do you mean like on DEXs, like the fees for using a DEX? Like, there's going to be fees always, but I would say on Solana it's pretty negligible, in my opinion. I don't know.
Yeah.
And then this one I wanted to respond to too. I think employees should not get tokens in DePIN. The token is rewarded to data providers. They should only get equity options in the company's entity. And this is one I have to kind of disagree with, because I kind of like the fact that they're getting tokens because they have a shared interest in the token being successful in the token price. if all of a sudden they have zero investment in the token itself and are only focused on the entity and that being profitable, I think that further disconnects the token from the fundamentals, or at least removes
it decreases value alignment is what I think
value
it
alignment.
does.
That's the best way to put it. Yeah, that's exactly. So I don't know that I necessarily agree with that, but I would like to see a point where being a token holder does actually give you true equity. Like, I think that would be really interesting and gives you those protections, because there's no doubt we are eventually going to see acquisitions. It could be Web2 companies buying some of these projects. It could be a DePIN project purchasing another DePIN project and combining. We've got to know what that means for token holders, and that we're not going to get screwed, because that's certainly a risk right now.
Yeah, it definitely is a risk. I pointed out a couple of those examples where we have some precedent here with the Stripe and the Coinbase example. The one interesting point to DePIN networks, specifically ones where you actually have to deploy hardware, is that if the company got acquired, the network got acquired, whatever that really looks like, the company that would be buying it would ideally want to continue having all of the hardware that's been deployed out there. And so I would think that they would be forced in some capacity to continue distributing value to said participants. Now, that could mean they totally kill off the token and they just pay you in fiat or USDC or whatever that is. But the one difference between like a non-infrastructure network and an infrastructure network is that if you're buying it for the infrastructure value, the only way to continue the infrastructure being ran is by the incentive to do so. And so I don't know what that would look like in a true, like if call it T-Mobile wanted to go buy Helium, they would have to keep all of these hotspots plugged in and running. And so you'd think they'd have to figure out a way to do that. So that might create a little bit of a variance between what we've seen historically and what that would look like in a DePIN network. But it is still a totally valid point that you don't have the same assurances as you do if you're an equity holder.
Yeah, it's something that needs to be figured out for sure. Do you have any other options that you saw that like were interesting to you as far as how they could connect the fundamentals to the token price? I mean, we went through quite a few here, but
I don't know if I've seen anything else that would be kind of a reasonable next step. I think that people seem to be divided between two camps. There's no benefit to doing buybacks, and then if you don't do buybacks, you're effectively a meme coin. And I think the continuum between those two is very small. So yeah, I don't know if there's any other key takeaways that could be looked at. I think, again, going back to how we started this is all one big case study. We're going to have to continue to try implementing various approaches. And so maybe this hybrid model, or sort of a reductionist between, a binary, we're buying everything and we're buying nothing, at least as it relates to the Helium Mobile side, could be an interesting middle ground. But I don't know if there were any other really insightful approaches to solving this problem that I've seen that could be tactfully implemented in any way, shape, or form right now. Did you?
No, I agree. I think that's valid. The big thing to me, again, is just like there has to be value accrual to the token, and how that's done, I don't know. For the people saying that like open market buys has zero impact, I just think that like that just doesn't even make sense to me, because mathematically, like, you're bringing in capital from outside of the ecosystem, from customers, whether they be Web2 customers or not, but it is new capital from outside of the ecosystem that's creating buy pressure. Like, to argue that doesn't have any impact at all in his financial theater, to me, is just a bad take.
Yeah.
I think that burning tokens out of a treasury and not having open market buys could certainly be looked at as financial theater, because to this point, we haven't seen that token burns have any impact on the price, or the market cares at all. Now, that could change. We haven't seen it happen long enough to where I think there's a meaningful percentage of tokens out of the supply. I think GeoNet's maybe like 2.5% of their supply. I mean, that's a decent amount, but I can't say that it's had an impact on price at all. So to me, that's financial theater burning out of a treasury. I think that's kind of bullshit, actually, because the treasury is just tokens that you create out of thin air anyway.
Yeah.
So,
Well, and I could be wrong on this, but I feel like more often than not, people are looking at the market cap versus the fully diluted market cap. And so like as it relates to that pricing disparity changing, it's somewhat unknown as to how this is going to be kind of seen in the market. Like if you've got there's plenty of projects out there. Like I know even in the early days, XNet had to address this because they had their current market cap, which was like, I think 20 million or whatever, but then the fully diluted was like $500 million. And people are saying, okay, this is totally disconnected. And so, you have to address that in some capacity, but I don't know how much, assuming that they're reaching a point of close to being net deflationary, or they have a way to kind of bring the fully diluted more in line with the actual trading market cap. I think that would lend to this whole like just burning the token or just removing from the fully diluted as those a net new emissions happen is a bit of financial theater, because if anything, what you'll see is the market cap would stay flat and then the fully diluted will just come down.
correct.
As you've got the kind of net neutral emission output. And so, I agree that there's less precedent to assume that that's going to be driving the underlying value as much as people, maybe myself included, historically thought was the case.
Yeah, it makes you wonder like how many people are looking at fully diluted valuation versus circulating. Like I look at personally circulating, and when I look at where I think the price could go with some of these projects, I look at the unlock schedule. I do projections based on a time frame. So I certainly, I think fully diluted is important, but I think looking at the current market cap is, in my opinion, more important. I'm not sure what people generally look at, but I don't think, again, I don't think we've seen a big enough decrease in supply from these burns to say that there's an impact or not. I don't know what that threshold is. If it's 10%, 20% of the supply, I don't know, before the market cares. But
Yeah.
I'm sure, well, we'll find out at some point. GeoNet's very soon going to be net deflationary unless the price goes up. Plus they're burning on top of that. They've got the halving event coming up at the end of June. They just hit 7 million ARR. They're projected to hit like 18 million next year. So you look at what's happening with GeoNet, and that's actually where I want to take this next, is how you're positioning for 2026. So I think that's a good conversation too that people would be interested in. But GeoNet to me is, just look at the math behind it. The revenue is on a crazy trajectory. Their emissions are dropping. They've got a very aggressive 80% of revenue going to open market buys and burns. Like at some point, something's got to give there. And
Yeah.
That's why GeoNet's one of my largest positions, is because I think they're doing all the right things, not just in the business side of things, but also on the tokenomics side of things.
Yeah, I really continue to come back to GeoNet being right now the best indicator for how this model can or cannot work, because you don't have some of the baggage that you've seen with other networks. Again, both between the more conservative emissions, between the halvening, between the revenue, all of those are lining up to making GeoNet arguably the best case study for how this can or cannot work. So I am also equally positioned, not probably equally to you, but I've got a larger position in GeoNet comparatively, because I think they're doing the right things. The other network, which we've obviously, we're rocking the shirt right now that we've been excited about, is 375. And we've gone deep into why we think they're going to be absolutely crushing it. And just the TLDR is the team, right? They've got a big market opportunity, and they've got a really good team that's historically been able to execute, and they're executing towards that reality, I think, quite well. So still an open book in terms of how that materializes, but that's another one I'm quite excited about.
The team, I think, is as important as anything. Looking at not just their execution now, but have they executed on things in the past, like Mike Horton obviously has. I think 375 AI maybe has the most impressive resume amongst their different founders, co-founders. And I was already sold on the fact that they're collecting this new data set on all the billboards across the country. I think we're already starting to see these AI models are very hungry for data. They've scraped the internet at this point for the vast majority of the data that exists. I think new data sets, new fresh data sets are going to become more and more valuable. You look at the fact that they're also doing, computing or processing everything at the edge with NVIDIA chips at the point of data collection. So I was already sold on that. I had Harry on that space, right? And he said, look, our goal is to get to 100 million plus in revenue. He's done it before through data sales with prior companies. So like, it's not like he's just throwing some crazy number out there. Like this is something they've already done.
Right.
So I think data is only going to become more valuable. And then if you see what they've announced recently, they're going to be launching some pretty cool stuff with their app. So they teased something about like a vendor thing. He also in a recent interview is talking about how they're partnering with some big name brands. So I think they're going to find a way to leverage the app to get revenue going even faster. Obviously, the billboard revenue is going to take a little bit of time, but I just feel like you look at the market cap too. The tokenomics unlock schedule is very attractive to me, and the tokens. The other context here is that they launched right after the largest liquidation event in crypto history. So the price has kind of been very suppressed, I would say, very well below what their investment rounds were valued at. So to me, it's just one of those clear examples that, when the market's down and with this much extreme fear, you got to be on the lookout for these types of projects, in my opinion. And that's exactly what I've done. That's what I did back in 2022, 2023. And that paid off very well. Yeah, it can be really hard to keep that in mind when the sentiment is so bad right now. But the things that I did in 2022 and 2023 paid off very well in 2024. So I'm kind of looking at this the same way. Like, okay, do the research, plant the seeds in the right projects while the market's down, and later when sentiment improves, I don't know when that will be. We don't have a crystal ball. I feel very confident that a lot of these projects I'm investing in right now will be a lot higher. And that's the hope, at least.
Yeah, I think that's a really smart, pragmatic way of looking at kind of the future of 2026 and beyond. I know that one of the other things that you and I have talked about extensively is that in historic markets or runs, there's always kind of the meta that drives value accrual. And so whether it's, back when I started, it was ICO craze, or you've got DeFi, or you've got whatever it is, meme coins, etc. It was pretty easy to spray and pray and get at least a 2x, if not quite a bit more, by just the fact that the narrative was hot. Mm-hmm. We have, in my opinion, and obviously there's always ingenuity that's going to happen and new creations that come as a result of innovation, but I don't foresee a historic repeat of what we've had previously, which is there's not a single meta that starts driving all this value. It's going to be the companies that have the team to begin execution. They're going after a significant TAM. They've got a really differentiated product offering that creates a moat, and then subsequently to that, they've got tokenomics that actually has kind of that value accrual mechanism as we've talked about. And so what I'm trying to find for kind of my next investments, and the ones that I already have, are going to be companies that they check all of those boxes, so that you're not required to have a specific vertical that's going to see the narrative become the thing. It's the companies that are doing it. And I think that the rest of the market's maturing to the point now where that's hopefully what they're going to be looking for. That could be naive, but I'm looking at everything that has ran in the last 7 or 8 years, and I'm struggling to find what's the next instantiation of that. It's in my world, or in my viewpoint, it's only going to be the companies that have the ability to execute. And when you see the market run, the companies that are running fit that category, not everything else, the long tail of companies that are just in crypto, because that's just no longer the case. So that's how I'm trying to look at my future buys and the ones that I'm holding right now. Is if you check those boxes, I think you'll do well, and the financial benefit will come.
Yeah, so I was talking to Ariel about this a few days ago, and kind of our outlook on what crypto looks like moving forward. And I think we're going to see a segmentation where you have your stablecoin payment system segment. I think you're still going to always have your casino segment. If it was NFTs, then it was meme coins. I'm sure it'll be something else Maybe it's like creator coins, something like that, or AI agents, whatever. There's
Yeah.
always going to be some sort of casino to play with over there. And then I think you're going to have your true projects that are building to generate revenue. And I think the market structure bill is going to be really critical for that success and to see the full upside there. Now, as far as like my thesis and how I've repositioned, very much in line with yours. I look at the team. Are they going to be able to execute? Are they going to generate revenue? I think obviously the tokenomics is a very important aspect to that, to make sure that there is, a tie to fundamentals in the token price. But realistically, man, like one thing I have to call out, and maybe I hope this changes, but a lot of these projects that we've seen in the early stages have their token run up a lot. Like, I think that some of those projects that have been around a long time still have upside from here. But I don't think that's reasonable for some of them, because of the amount of dilution they've had, to see them return to all-time highs again.
Right.
And that's just calling it what it is. So one of the things I'm particularly looking at is something that, checks off all the boxes, but also add that element of, okay, they still have a extended period of time before they're going to have mass dilution. Find projects that are early stages enough where their token unlocks haven't happened for investors or employees. There's a lower float, that's the market cap's low, because I think those, in my opinion, have a lot more upside, the ones that haven't had their run yet. And in particular, projects like 375 AI, like your Rover, Aoki, I would argue, is another one in that camp. There's more that I'm sure that I could highlight here. I think GeoNet's another one, obviously. So those are the ones that I've really positioned into, and in particular data collection, because as I mentioned, I think data is going to be very valuable, whether it's Rover training autonomous vehicle models, whether it's 375 AI. I think that the data they're collecting is going to be incredibly valuable. The other is robotics. And I think you've got to position, and paying attention to the Web 2 space, I think is really important in this, because we saw this with AI. Look at the AI data center build-outs. We saw the GPU projects run like crazy in 2024. And I think, you can look at the parallels in the Web 2 space right now with robotics. Like, look at your Figure AIs, your Apptronics. Like, these different companies are getting billions and billions and billions of investment. And we're seeing this similar type of thing that we saw with AI companies, where, and prediction markets is another one, by the way, but where we're seeing the valuations increase every 3 months, doubling, right? So I think you can start to see that robotics is going to be, in my opinion, a place where a lot of capital is going to be flowing. I think that you're going to see robotics outperform a lot of the market. And that is why, in the DePIN side of things, I'm looking for these early stage robotics companies and projects, and I've positioned pretty heavily in a lot of them. Another one's Ex Machina, where they're actually a DAO investing in some of these robotics companies. I just posted an interview with their CEO recently. I know you've interviewed him as well. So that's another one. They're having a community sale here in a few days, but that's kind of how I'm looking at this. Early stage, cross off all the boxes, and just hitting those narratives that I think are coming that most people aren't necessarily paying attention to yet.
Yeah, I think you hit the nail on the head. There's a couple key factors in there, which one is, what does the price look like relationally to the market cap? And what I mean by that is, you had Solana, when it ran up in 21, 22 or whatever, the market cap was actually quite a bit lower than what it is now in subsequent run-ups because of additional emissions. And so that has to be one thing that's factored into the equation. The other piece, and you didn't say this explicitly, but I think it's also kind of a key takeaway, is how important is, this is basic fundamentals. This has always been a problem in crypto, but it's like, how fundamental is the token to the model actually working? Because I'd argue that there's a lot of projects out there where they have this as kind of a, call it secondary, it's like a secondary IPO or a secondary value, investment round that they're able to get money in just because they can and because they will. But I think it's also really important to look at how fundamental does that token become to the success and eventually value accrual of the network and their success. And so if there's a fuzzy line between the two, I generally stay away, just because I don't, then it's no different than a meme coin, right? It's all speculative fervor. And if you don't have any relationship there, or if the relationship is murky at best, that makes me quite nervous from an investment standpoint.
I agree. Absolutely agree. And one other one I want to throw out there is Silencio. So I want to use this as an example because they're a project that's pivoted. So we saw this with Helium, right, where they got revenue turned on. Silencio still hasn't really had their run at all, I would argue. And they have pivoted to the point where they've got a lot of potential revenue that's about to come through the door on the space that we had them on. They also announced that they're going to be doing open market buys and updating their tokenomics this year, likely this month. So to me, those are the things to be paying attention to because you can find undervalued projects. I would say that probably more than 90% of the people that maybe downloaded the Silencio app in the beginning thinking that they were just selling noise pollution data and mined the token and sold it.
Yeah.
They're unaware of these changes. So you can find, outliers like that. Now, I do want to call one thing out because I'm in a Discord channel where this Alexandra guy, he called this out. He said, hey, something to keep in mind is that on January 25th, there's a large unstaking that's taking place for Silencio. So that's something that maybe, I plan on DCAing some more, but maybe that's something I see how that plays out. If there's a big dip on that, January 25th, 26th, that's something that I would be looking to aggressively buy. So those are the things you have to pay attention to as well. What are some future events, whether it be token unlocks, unstaking periods, where there could be a lot of sell pressure to take advantage of. So that's something I'm certainly keeping an eye on.
Yeah, you've been probably the most vocal analyst, if I can put you in that category, for really paying attention to the unlocks. I think intuitively most people understand that that's a variable, but I think you have probably been the most vocal in terms of public analysis of saying how that impacts either your interest in buying or your timing of buying more specifically. That does need a bit of attention because we've seen, whether it's through airdrops or through these various tokenomic related schedules, having a direct impact on the price. And so if you're not cognizant or if you're not looking at what's ahead, that can impact timing. It can impact price when you maybe want to participate, maybe when you want to get out. That could be another reality too. And so I think it's a good thing to be able to call out and just pay a little bit of attention to. I mentioned this over the holiday break. I'm going to be working on adding some data around this on DePIN Pulse, which is kind of a collab project between EV3, Who Loves Burrito, and then ourselves at Unleashing DePIN. But I think it's when you're trying to analyze these various companies, that's really an important factor that does impact things quite materially. And so if you don't have good insight or just clarity into what's happening, it can very much distort your view on the viability of the token price, so on and so forth. And so it'll be coming at some point. I've had my hands busy with a few other personal projects, but it's a really good thing to call out that hopefully people take note on.
For sure, man. Yeah, I know you got a lot you're working on right now. Prediction markets is a thing, maybe. So prediction markets are also I'm trying to find investments that are in line with that. I think some of these protocols are going to launch tokens. They'll do really well. I mean, that's another area. The robotics and the prediction markets is a ton of money is flowing in. You're seeing, I think, like Polymarket went from like a $2 billion to a $5 billion to a $10 billion valuation. It might be even like $12 billion now in a matter of like 7 months. So you're seeing like that money flow in. Crypto.com's launching. Yeah, I think prediction markets are going to be absolutely massive, bigger than people realize. Like there's a billionaire that was quoted as saying that, hey, he thinks in the next 10 years, prediction markets will actually be larger than freaking equities than stocks, which is insane to think about. But I use it a lot in my streams and when I'm looking at macro, because understanding sentiment is so important that you can see how much the market's baked in events before they happen. Like the Japan reverse carry trade is a good example of that. Everyone's like, oh my God, like this massive sell-off's going to happen. It's like, well, we kind of knew that this was coming for a month at this point, if not longer. And it's 99% baked in, and everyone's like, well, how come it didn't sell up? It's like, dude, pay attention to prediction markets. You know?
I don't think that take is off base, by the way, because when you look at the price difference between derivative markets and like just like the underlying equity markets, there's a massive disconnect in amount of both value and how much is traded there. So I think the prediction market model is going to be huge. And I've spent quite a bit more time over the last few weeks and months looking at that as a way to either get an edge or try to participate in monetizing said edge. But they are 100% becoming the norm. I'll just leave you with a funny anecdote on this, which is I'm in my fantasy football chat. One of the guys in there is my brother-in-law. He said he posted like, "Oh my God, Robinhood's got these prediction markets now built into it." I'm like, dude, I sent you something about this months ago, and it's one of those things where there's quite a bit of non-crypto retail people waking up to what's happening in the prediction market space. So how that translates to DePIN, probably not a huge correlation. There may be some overlap there, but I fully agree it's going to be maybe the dominant narrative of 2026.
For sure. And it's interesting because I was like, how would that happen? Where it could exceed the equities market. But an important distinction to make is, equities and their market caps are tied to an actual business, and there's a limitation there. Prediction markets are tied to the money supply. I mean, you can put an unlimited amount of bets out there, and people love to gamble. Let's be real. But I think it's going to be valuable not just for understanding like macro, but for companies understanding market trends and being able to market properly, like understanding sentiment. Like there's going to be so much value there. And one way that it could overlap is one you brought up before is like, okay, so these weather projects in DePIN, you could leverage that data to make money in prediction markets around weather. Like, so I think there is going to be some overlap, but it's something that I'm certainly looking at because, again, looking at the parallels, looking at the Web 2, where the capital is flowing, I think it's really important to look at opportunities that might align with that. And there's certainly going to be some, and I would like to find them before everyone else does.
Yeah. Well, and it goes both ways too, right? Where it's not necessarily just taking the data and betting on the prediction markets, but it's also leveraging the data for the prediction markets as they're crafted. Like I literally paid money the other day because I've been going down this rabbit hole of how all these poly market arbitrage opportunities are happening. And so I paid money to join the stream. And one of the guys said, you should look at whether, so his case was, if you want to be able to try to predict what's happening with supply chains and you can make money in that, you should look at the weather data at the ports. And I was thinking, well, a 375 model where they are tracking transportation directly through what they've called NFL cities, so ports and other kind of macro environments, is a really good data source that could drive how some of these prediction markets are set up and crafted. And so I think that you could both leverage it to potentially get an edge. Obviously, hedge funds have been paying for that kind of data historically for a long time to be able to figure out what's going to happen at maybe a macro or even a micro level before it actually materializes. And so letting that flow into the prediction markets and then also seeing if you could leverage that to be able to bet on them is going to be a very natural progression that we see within these prediction markets. Again, it's a little bit more niche and comparative to things like gaming, or not necessarily gaming, but like sporting events and news trends, et cetera. But I think there's going to be some overlap without question.
Yeah, and I think like this is a good example. Like, who's going to be the next Fed chair? So the market right now, like these have moved a lot, right? And you have the two Kevins at the top. I actually, the more I've researched it, I don't think either of them are going to be the selection, honestly. And I'm planning on putting a no vote on both of these, and I think the payout's pretty nice there. But I think Kevin Hassett, like he would do the things Trump wants, but there's already so much blowback on him that he's too connected, and I think people close to the White House are pushing back on that. Kevin Warsh, looking at his views on things, I don't think that he would cut rates. And Trump's made it very clear he wants someone to aggressively cut rates. I don't think either of them. And then the book I just read went into detail about when Jerome Powell was selected during Trump's first presidency, and he, Powell was very much a dark horse candidate. So I actually think Waller, because Waller is right now, I believe he is one of the Fed members right now, but he's kind of a middle of the road between Hassett and Warsh. He'll do the things as far as cutting rates that Trump wants. He also would be somewhat of a dark horse candidate because he's not a favorite. I actually think there's a decent chance it could be him or someone else that we're not even looking at right now. But I do feel pretty strong that I don't think it's going to be either of the Kevins. And so that's something I'm looking to probably the next day or two, put some no bets on and see how that plays out. And, as the odds change, you can, close those positions and sell those positions, right? As the odds shift, you can get a payout.
That's the other thing that I love about these prediction markets. I know we were chatting a bit about that as well, which is that it's not a binary outcome event, because as the odds change, you do have the ability to buy or sell, which is totally differentiated from what you see in like sports betting, which I really don't do because I'm not a sports betting kind of person. But it makes it quite compelling from an investment standpoint, because you can be halfway right and still make money without requiring it to go all the way to a yes/no decision. And so that changes the game quite significantly for me, at least.
Yeah, no, I agree. I think this is a funny comment, and it's probably true. We'll see huge bets right before the pick is announced from a fresh unknown wallet. How many times have we seen that? People with inside information. Dude, how about that guy that created that algorithm though? Like genius. As far as like the Venezuela attack, he basically had an algorithm built on seeing when there'd be elevated pizza orders in DC. So generally, if you see that means that they are planning an attack of some sort. So he knew, he's like, hey, look, I knew it's going to happen at some point, and his algorithm was able to detect that there were elevated pizza orders, and he was able to put a bunch of bets in. He made like 80 grand on that. Freaking crazy, man.
I think it's huge. By the way, I did actually bet on the Venezuela one, and I bet on the 31st. I actually lost, because this is where it becomes interesting. You actually have to think a little bit harder than just what you're seeing and kind of the news cycle, because the nuance of the way that the poly market bet was set up was, will it be a military strike? And because Trump didn't say it was military or CIA or whatever, it actually lost. So that's where it becomes, both a challenge and fun, in the sense that when you have that edge, you can use that to your advantage. But there's all these other nuanced components to it that make it less straightforward from how do I just make money in this case? Because yes, that was one example where it worked. In my case, I didn't really have an edge other than seeing Russia told all their dignitaries to get out. And I'm like, all right, well, I think that's a good signal. But I ended up losing because the details of it were not in line with what ended up happening. So sort of a bummer on that front. But
yeah, you have to read through those details for sure. I did cover that on a stream earlier this year. I know we talked about it. I have to go back and find that, where I went through how the decision oracles are and how the decisions are made, and ultimately how it's settled. Because there's one that was like under scrutiny, and that's why it came up. And I have to go back and look though. But it's kind of fascinating to see how it played out. What do you say? There's another key component to who says that's true or not. Yeah, well, that's exactly right. So I'll go back through. I'll cover it again on a live stream here soon. I think it's worth bringing up again. I'll see if I can go back and find that. But yeah, there is like an Oracle system, and what's crazy is there's not that many people that are really the deciding factor on some of these. It's like a very limited amount of people, so it's very centralized. And that was the whole argument. It's like, hey, that's kind of like effed up, man. Like that you have so few people that have so much control over this and the actual decision and how it plays out.
I will say real quick on that point, there is, if you want to go do your diligence, feel free. There is a ARB opportunity, given the fact that there's only a few oracles in most of these cases that end up calling yes or no, that you can arbitrage and front run. So I'll leave you with that tidbit if you want to go figure out how you can maybe make some money that way.
Interesting. Well, man, we are coming up on
2 hours, Brad.
Almost 2 hours. I want to pose this question to you as we close, unless you have something else you wanted to bring up.
No. I was just going to say, this is like almost as long as some of our phone calls go when we're chatting about this stuff. So I'm glad we got to have it.
For sure. Yeah, we probably would have had this conversation anyway, so I might as well do it on camera. So, for your market cycle, is it intact or is it broken?
I think the 4-year market cycle is dead. I am a staunch proponent of it is driven by the business cycle.
Yes.
And I think there's quite a bit of strong evidence to support that position. So I know it can seem sometimes timely, but if you look back at historical trends, I think there's a very compelling case to be made that the 4-year market cycle is dead. We are driven by the business and liquidity cycle, as the liquidity drives the business cycle. And that's my final take there.
Hey, I tend to agree with you. I think we might get to a point here where both sides can claim victory. So, we had the 10-10 October 10th event. Keep in mind, it was just 4 days prior we saw Bitcoin hit an all-time high, which is pretty crazy, right?
Yeah.
And it's really been just about a year, just over a year, that Bitcoin hit 100,000 for the first time ever. I think we forget about that. People have such a short-term mindset. Like August of 2024, Bitcoin is sitting at like below 60, I believe. So,
Yep.
so it's not that long ago. I think that things kind of aligned though, and became a self-fulfilling prophecy here. You had the washout on October 10th, the government shutdown that kind of pushed out a lot of the spot ETFs that everyone was hoping for. But that liquidation event, which obviously was made multiples worse because of Binance and their negligence, frankly, and I would hope they'd be held accountable. Probably won't, especially like CZ was like just like pardoned right before that, which is crazy to me. But I just think that all that kind of happened and aligned with the 4-year market cycle, which just like created further selling because people then were, again, a self-fulfilling prophecy. Like people are expecting it, and then they're like, oh, it is the end of the 4-year market cycle, and just like kept selling.
Yeah.
The fact that Bitcoin is still holding up here, and like if you look at social sentiment, we have not seen anything near like what we would normally see in a market cycle. I think a lot of that is liquidity driven. And this has been an institutionally led market cycle to this point. So I think we are starting to see the Fed balance sheet expand. You pull that up. I mean, that's one factor. I think the business cycle, if we see that get over 50, was it the ISM, right?
Yep.
That would be very interesting. So I believe we have brighter times ahead. Now, I will say, and we talked about this, I don't think it's going to be like prior market cycles where everything just moves at once. Like I think you have to be a little bit more diligent. You're gonna have to do the research, but I think the research will pay off. And in my opinion, it doesn't mean we won't see more capital flow in than we've seen in the past. I think we probably will. And I'd argue we haven't really seen a lot of new capital in general. When you look at the alt market cap, while it did move up and meet the all-time high from the last one, you have to keep in mind a lot of that was token unlocks adding to market caps, not necessarily new capital coming into the space. So you got to think about that too. Right. But if you look here, guys, we're seeing it tick up. Look at that. It's a little guy, but it's happening.
Yeah.
It's happening. So that's cool.
You said something that I think it's hard to quantify, but the psychological reality of markets and consumers feeling comfortable to spend is such a key point that, again, because it's difficult to quantify, it's hard to know how quickly that'll begin materializing and some of these changes that are happening. But if everybody thinks it's going to be doom and gloom in the next 2 months, no one's going to want to spend money, no one's going to hire, no one's going to be expanding their businesses. It's not so stark to have 0 people doing that, but the reality is it's going to be challenging. And so hopefully with the expansion of the balance sheet, that's going to lead into additional liquidity that will start to improve the sentiment or the psychology of businesses wanting to spend money, consumers more importantly wanting to spend money, getting that flow happening. But you can literally talk yourself into everything's going to 0, and then you've got mass capitulation because the entire, everybody's a lemming, right? They all think the same thing. And so, it's really hard to create that catalyst, but I do think the liquidity driver is going to be one variable in this equation that'll help kick that off. So I'm cautiously optimistic, as I always say.
Yeah, look, Russell 2000 has been surging, so there's risk appetite coming back in smaller caps. That's something we haven't seen, and really, like, we saw everything kind of detach from the market after October 10th. Like every stocks have hit all-time highs. Gold, silver has been running. Like crypto was going in the right direction until that event took place. I think it's taken time for liquidity to get restored. But the other thing I want to call out here is, like, you look at a lot of markets, right, that are you could look at as overvalued. I mean, the stock market's hitting all-time highs. Gold has been on a crazy run. I mean, look at this, $30 trillion. Silver's up to $4 trillion, guys. Like Bitcoin is down at 1.8 trillion.
Yeah.
Like when these people are starting to look at, okay, where can we rotate some money to get ahead of the next capital rotation? I mean, are you going to want to go into stocks that are already at all-time highs that are arguably overvalued? Or, I think crypto all of a sudden starts to look kind of interesting to people because it is the one thing that hasn't been at all-time highs. And in fact, has been really beaten down to an extent we haven't seen. So it wouldn't take much of a capital rotation from some of these other asset classes. The liquidity is increasing. We see the government or the Fed's buying T-bills, right? And if we start to see the business cycle expand, it's not that difficult to see money flowing into crypto, in my opinion. And then the question is like, well, is there an alt season? No, and if you ask people if there was an alt season in this market cycle, I'd say 99% of people will say there wasn't. I would argue there was. We saw HighMapper do a 30x. We saw Nosana do a 350x. We saw Demo even do like a 15x. If you're in the right positions, in the right plays, like there was an alt season, just wasn't very long. Wasn't what we were accustomed to seeing. I think we're going to see a similar situation moving forward where, we've been extreme fear. We'll get to extreme greed again. It happens and it can happen quickly. You've got to be in the right assets though. And I think it's important to play the volatility to an extent too, because it is an inefficient market. That's one thing I got wrong, I think, in 2024, is that I think I gave too much credit to the maturity of this market.
Yeah.
And I think it's important to keep in mind, like, hey, market inefficiencies are there, that you have to play the volatility or you're going to end up round tripping a lot. And I don't think there's anything wrong with that. Like no one's giving Warren Buffett shit for sitting on $300 billion of cash right now. And it's probably more than that. I mean, you need to be able to identify when things get overheated. Fear and greed index is a good way to do that. And judging market sentiment and market psychology there. It's, the time for like that I'm investing is the most uncomfortable time to invest when everyone calls you an idiot. The time to sell is and take profits and chips off the table and preserve your capital is when everyone's telling you can never go down again and that you're an idiot for selling.
Right. Right. It's true, man. I know this is one of the other things that we had chatted a bit about, which, I having come from the ICO craze, and, I wouldn't necessarily say I was like an insider, but I saw some shit. And what the downstream effect for me, at least, was the fact that I've now completely viewed every other run up in crypto as this is just a repeat of what's happened. And so there's, the market is incredibly inefficient to my own detriment, where I end up not pricing or not buying into things in a way that would make me a benefit of the upside that happens. And so I think that is starting to change. But to your point, we are still a very nascent space, and it's still quite inefficient comparative to other markets. But by the way, I know we're like kind of long on this, but did you bring up on any of your streams recently what's been going on with some of the I don't want to call it fraudulent behavior happening in the silver market, but where they're kind of over shorting what is actually going to be available and then retracing it by saying, yeah, we'll give you the yesterday's price in dollars instead of the actual silver. Have you covered that at all on your stream?
I haven't yet. This is my first stream like the last 2 weeks, dude, which is crazy because I was back in St. Louis, back at home, visiting family, so I haven't been on in a while. It is something I'm going to cover, but like, yeah, man, like the amount of the amount of shorting on silver exceeds the actual supply substantially, and some of these financial institutions, if they actually had to deliver on that in physical silver, they'd be totally screwed. So yeah, they made some changes, man. Like they basically set up that they can give you a cash payout based on the prior day's settlement price, as opposed to delivering physical silver. And I think that's another thing that could actually benefit crypto. You and I talked about this. Like
100%. That's why I brought it up, because I think it's actually a potential catalyst if this does go south.
I 100% agree, because if people start losing confidence in their precious metals in the way that that's structured, I think that it benefits crypto, in my opinion, and Bitcoin being able to self-custody and actually see on chain that you hold the asset. So I think there's a lot of things that are working in favor of crypto. And I would say maybe the biggest one is that I've never seen the sentiment so negative. And I think that people are at like max exhaustion and have given up. And I think that's when smart money's positioning. And that's when they want to make it the most hated rally ever, when no one's there to experience it except for smart money. So I think that we could see certainly a nice bounce back this year. When that happens, I hope it's soon, but keep in mind, May, we're going to have a new Fed chair in there, and they're going to aggressively lower rates. I would imagine that we're going to keep this schedule up of buying T-bills, moving our debt to the short term time frame on our debt. And then this is important. Like, the more and more I've read like 10 macroeconomics books this year, and it's so true. CPI might come down. Rent prices are coming down. Gas prices are probably about to be pushed a lot further down, which is very correlated to CPI. But the asset inflation is crazy. Asset bubbles, we've seen it time and time again since they started QE back in 2008, 2009. And moving forward, the more that they print, the more they suppress rates, the more asset bubbles exist. That's really good for risk on assets like crypto, like your stocks, home values, any assets. Really, you're going to see them continue to appreciate as the value of the dollar depreciates. So I think that's another thing that obviously bodes well.
Yeah. I am excited for the opportunity for my current investments to hopefully be a beneficiary of whatever happens with respect to massive money printing.
Yeah.
Not that I think that the long-term benefit is going to be good from that, but short-term assets will, or in the short term, those assets will hopefully do well.
Yeah, I agree. He talks about the fraud in silver. There's been fraud in silver for a long time. I mean, there was was the Hunt brothers? I forget. I got to go back and read. I listened to a couple of really long podcasts about this, but the silver fraud has been around for a very long time with them suppressing prices. This is nothing new. But anyway, man, yeah, I remain very optimistic. 2025 was a really tough year. The fundamentals kept getting stronger. The prices were awful. There's a lot. I think there's a lot that I learned really about market psychology and macroeconomics. The amount that I know now versus then is crazy. I feel like I'm very well positioned moving forward, but you got to stay on your toes, man. Like, no market cycle is ever going to be the same. So you got to continue learning. And I think it would be hard for it to be much worse than it was last year. Knock on wood, famous last words. But I think a lot of us got hit pretty hard last year, man. So I think we're ready for some good news and some positive price action. I know I am.
God, it'd be great. It'd be really nice. Need to have that happen.
Let's go. All right, man. Well, that was a good session. I don't know if you have any final thoughts to wrap this thing up.
I just want to say, number one, thank you for everybody that's been tuning in and listening to us go on about this. I'm both encouraged by kind of the feedback, just circling back to our initial conversation, just the feedback and maybe the engagement that's happening with people caring about, kind of these esoteric, somewhat novel, somewhat difficult to maybe always understand components in crypto. I think it's part of the maturization, whatever the word is. Maturation. Thank you. I was like looking at my mattress next to me. It's like match. So I think that's healthy. I think some of this discourse is going to translate into kind of the next evolution and just continuing to have projects do better in the long term. So hopefully this can be a historical learning event rather than just we did this stuff and no one ever paid attention. So that's looking good. But I'm excited, man. I'm excited to keep doing these conversations, doing it live, having an opportunity to get feedback, be challenged. I've been wrong so many times, and I love when people poke holes in theories. And so that's part of the great thing about having these public conversations is that we can actually put our ideas out there, our thoughts, and folks can challenge them. So this is awesome. I'm excited for more Sunday streams, Brad.
Me too, buddy. Me too. Yeah. We've been wrong. Like, one thing I'll say is, like, picked a lot of winners, but didn't time the market very well and understand the psychology well enough. I spent like more time than you can imagine this last year, better understanding that. 'Cause it's like, and this is something we talked about. This is your third market cycle. This is my second full market cycle. It's like a lot of times the first market cycle, you kind of get your feet wet. The second time, you end up, in many cases, round tripping more money than you'd like. The third is where people generally kind of make it. They have things figured out. No, you never have fully figured out, but certainly have learned a lot, man. I'm super excited, looking forward. Like I feel much more prepared than I have felt in the past, man, for sure. Like kind of pulling it all together, but very excited. And I echo your point. Like for anyone that's been here through all of this, man, give yourself a pat on the back, because it's been hard, man. Like the sentiment right now has been crazy negative. So I think it'll pay off in the long run. That the seed you plant today and have been planting over the last year, you'll start to see the benefit of that this year, into next year, and into the future. So it's just like, even though it doesn't feel great maybe at the moment, just keep that in mind, that there will be brighter times ahead. And that's all I got to say, man. So looking forward to our next session, Tyler. And I think we're going to do it once a month to start with, and we'll see how it goes from there, man.
I'm excited, man. So next, the first Sunday of February, we will be here. Hopefully good things will have happened in the meantime. So
perfect. All right. Well, we will catch you all next time. Have a fantastic rest of your Sunday.
Thanks for tuning in.